I'm going to welcome to the stage Danny Talwar, Elizabeth Morton. How are you, mate? Grab a seat. Neil Pereira from Deloitte. Elizabeth from RMIT. And Adam Saville-Brown from Koinly as well. And I'm going to leave you in their company.
Awesome.
Cool.
Can I grab your mic?
Yep.
Hey, everybody, and thank you for being here today. So firstly, my name's Adam. I'm the general manager here at Koinly and run the Koinly team. I'm sure you've seen a lot of our branding kind of around today. Can I say, firstly, it's a pleasure to be here and to see so many people. So welcome to Koinly Presents Australian Crypto Tax Landscape featuring RMIT and Deloitte. So firstly, I wanted to say thanks for attending, and it's a pleasure to be a diamond sponsor here. Walking into this event today, we didn't know what we were going to be walking into and what we're going to be seeing, and to see such a massive queue, and I know it's been a point of contention on the app, but to see such a massive queue of people in the community who have come here today to learn more about cryptocurrency and its impact in both the global markets and local markets, and to come together as a community to understand more is fantastic for me. I mean, I'm a big fan of blockchain and have been for a while. It's one of the reasons I took the position at Koinly to help grow it. Actually, I have 2 rocket tattoos, one up, one down. Just like the market, the down one gets used a lot more recently. But what is Koinly? So Koinly, for those that don't know or haven't seen the branding or the booth, is a software company that allows you to connect all your wallets and exchanges. We have over 770 exchanges and wallets connected that understands your trades. Because I was speaking to an accountant recently, and we had a bot trader who basically had 800,000 transactions between October and now. And an accountant was like, you can't pay me enough on an hourly rate to go through there and understand whether I've made money or not. But according to the rules, that you got to go through and understand what is a taxable event and whether you've made capital losses or capital gains. And basically, our platform allows you to bring all that into one space and get a report that tells you how you're doing, essentially. And you can generate that every year. And with us being able to do that, we've been doing it for the last 4 or 5 years around the world. And this year was the first time that we were asked to build an office. And we built an office. Our first office in the world was in Australia. And within the last 6 months, we went from a decentralized company to actually having offices in 4 places in the world. So here, London, Canada, and India is where we're currently based. And we're constantly developing to help people understand the ever-evolving landscape of taxation and the regulations in cryptocurrency. So that's probably enough from me talking too much, because otherwise I'll be here all day on the mic. That's kind of how I like to roll. What I'd like to do is introduce the panelists that we have here today, and it's a pleasure to be able to sponsor an event like this, to have a panel of a topic, and to see so many people interested in learning about taxation and the regulations in Australia. So firstly, I'd like to introduce Neil Pereira, who's an international tax and legal partner at Deloitte. He's a tech, media, and entertainment and telcos industry leader with 23 years experience in tax advisory and tax controversy. And as we know, cryptocurrency can be a controversial subject on this stuff. And also to my right, I have Dr. Elizabeth Morton, who's a researcher at RMIT and part of the Blockchain Innovation Hub. She's a lecturer in taxation, and prior to that, an academia in accounting and business taxation. And at the end here is a good friend of mine and also a colleague, Mr. Danny Talwar, who is our head of tax at Koinly. We take it so seriously at Koinly that we wanted to make sure that we hired a tax professional that worked with us, that can work with both the ATO and the government bodies and understand the regulations as they change, and even contribute to them where we can. He comes from 10 years at Deloitte, 3 years at BDO, and is here to help provide insight in cryptocurrency tax practices. And also a crypto enthusiast and has done many courses on this subject, including one at Oxford University. So now that's kind of enough for myself, so we'll pass on and move on to the discussions of topic. Firstly, we would like to discuss the cryptocurrency tax rules. So I'll probably pass on to Danny as a starting point and ask Danny, what is the common misconceptions with crypto tax? And remember that the audience here today is a mixture of people who are well versed in cryptocurrency or maybe new to it and trying to understand the tax implications of the cryptocurrency, either gains or losses that they've had. But so Danny, what is the misconceptions people have?
Yeah, so I think firstly, it's really important to remember that there's a lot of uncertainty in this space, not just from an individual investor perspective, but also when you're running a business. And it doesn't necessarily need to be a small business, but even large businesses are facing a lot of issues and complexities in this space. I think certainly from an individual perspective, one of the key issues that people are having is around whether they're actually running a business, whether they're trading as an investor. You know, they might see it as a hobby, but they might have advanced trading strategies, which puts them more into the business context or the business category. And obviously there are different tax rules and tax treatments for those categories as well. There's a lot of misconception as well between, and I think this is one of the main ones, is just around the level of taxing points that the ATO guidance has come out with and what ordinary investors will see as in terms of how they interact with different protocols and how they're trading. And so often the economic outcome that you're trying to achieve, perhaps from a DeFi activity or you're lending or borrowing, compared to when you get actually a taxing point or a CGT event for investors, is a really confusing topic. And at the moment we're seeing a lot of guidance from the ATO stating that there's a lot of disposal events that happen when you move crypto assets from crypto to stable coins. You provide liquidity to protocols. At the moment, the ATO are saying, well, there could be a disposal event there. And really it's just challenging the existing tax frameworks that we have. And so there's a lot of misconception around how we deal with that. And on the other side, what we also see is a lot of accountants struggling to actually keep pace with the innovation that's happening in this space. And a lot of the initial, a lot of the way people are trading with these assets haven't been seen before. Even just the innovation on the subjects or the topics, DeFi protocols, it's really hard to say these are similar to what people have actually used in a traditional finance concept. And so what we're seeing at the moment is a bit of a lack of knowledge on, certainly from advisors perhaps, but I think from accountants actually dealing with crypto assets, not necessarily understanding, well, what are you actually dealing with? What are you doing? How are you trading with it? What are your intentions? So I think that's one of the big misconceptions around.
Yeah, and so even at the beginning of the year, even the ATO kind of just saw cryptocurrency and Bitcoin as kind of the same thing, and even recently changed their guidelines to understand more around airdrops and staking and trying to understand that. So one of the most important things that I've seen is actually understanding that as our community of trading and cryptocurrency and the technology grows so quickly, even the regulators and the government are playing catch up to understand that and bringing out new regulations and rules to try and understand that. And, one of the things that really surprised myself was if you're trying to get to an altcoin and you go from, from say Bitcoin to Binance Smart Chain and an altcoin, working so closely to Danny, I now understand that those are actually 3 taxable events, right? So if you think of every trade that you've made, even if you're changing a coin to another coin and realize that's a taxable event, that's pretty wild to think about, considering that we went into that not even knowing that. And with that, I guess I'm going to ask, what are the more complex uncertainties? And I may pass this one to both Lizzie and Danny to add in, but what are the more complex uncertainties around the tax treatment from the ATO?
Well, firstly, I think we can't dismiss DeFi as a critical challenge for taxation, and that is even more accentuated by GameFi, where you overlay all of those activities that are really truly complex financial arrangements that we haven't really seen before, and the tax system is yet to really truly characterize, and this goes into the various forms of staking. I mean, what do we mean by staking? There's a multitude of different ways we can stake, and how each of those are going to be treated for tax purposes are going to be different. We can look to ATO guidance to say, well, okay, there's ordinary income being derived, but even that in itself is complex and problematic, because the question becomes, well, when is it derived? Is it derived at a point of crystallization? It really depends on a protocol. Could it be technically derived at every second it clicks over? Potentially, and to what extent can technology and software like Koinly really even compete with the mechanisms to actually try and map that out to actually get an accurate outcome? So then you put in the mix, who's actually undertaking this activity, and I go to the GameFi here in particular. We can have very inexperienced parties, everyday people playing around with these very complex financial arrangements that you only need a minimal amount of investment to actually begin. That can be contrasted with share trading, when there's generally a minimum spend required. You can end up with hundreds of complex transactions, income points, with less than $5, and that's critically problematic from a taxing point of view. And if this is within the gaming space, so we just heard in the prior discussion in this space today about the gaming mechanisms, the fact that you can play games now and earn assets because you own those assets. Well, that means there's even more complex taxing complications there. So that 9-year-old playing around in this space, earning those assets, how are they going to deal with their tax return obligations? So it's not only the level of complexity here, but it's also the mechanism, the administration of the tax here is very unusual. We've already made the point that it's very time consuming, it's very challenging for a tax practitioner to make sense of it. So how's a taxpayer meant to make sense of it, particularly if they're not even using a tax agent? Maybe they're using my tax to complete their tax obligations. So what level of knowledge do we need when we can't even get a clear understanding from those that are actually specialising in this space? So I think there's a whole multitude of problems, not only to the complexity itself, but to the understanding, to the education and the administration. It all comes part and parcel of this really new, this fast-paced area that's really challenging the very core of this regulation.
I was getting an Uber home one night, actually, and the Uber driver saw kind of my Koinly t-shirt and crypto tattoos and was like, "Oh, you work in crypto? My son's been playing games and like trading money. It's so good. I've not had to give him pocket money for like 2 years." And him and his friends all seem to like always have new clothes and it's all great. And I was like, awesome. Like, have you thought about the tax on that? And they're like, well, he doesn't need to be taxed. He's not 18. And I was like, look, I'm going to have to text you some discount codes, okay? Because you're going to have to plug this in and see how much tax your son actually owes. So yeah, there's all these popular misconceptions. Neil, I see you're about to say something.
I was just going to say, I think everyone in this room is probably well educated, but I guess there's a lot of people getting into this space that probably think, well, we can get away with not declaring it. And I think, as Liz was saying, the tax office is running a really big program at the moment just around the individual space, let alone the business space. And they're sort of plugging into exchanges. And some of you may have received letters last year saying the tax office knows that you've had some transactions. So there's a big campaign to just get the population to kind of acknowledge that, yes, this sort of stuff is taxable. But the missing, I suppose, the gap is when is it taxable? That's the challenge. And as the industry sort of evolves, the traditional tax laws aren't keeping up. I think we've seen it with tech companies in the last 15 years, and now crypto's sort of getting very close to that as well. It's very hard for the laws and the rules that we have to actually work out what's the right taxing point when the products that you're getting into are so maybe complex or so advanced that they don't keep up. So what we're seeing now is a regulatory change coming through. So the Board of Tax is actually looking at, well, how do we look at the tax system? And this is not just in Australia, like the world over. Some jurisdictions, maybe happily for us, still don't tax crypto. And maybe some of you want to go there, but by and large, we're going to see a lot more tax systems bring crypto into the net. And the tax offices are looking at, well, how do we do this? So there's consultation at the moment. Danny's been part of that. Liz, you've probably been part of that too, to look at, well, how should the tax system evolve to just keep up and capture all of this? And that's just on the individual level.
Yeah, that's really interesting, and that actually takes us to our next point. But to know that the government's out there and approaching people like the three team members we have up here on the panel and asking for advice is at least great to understand that they're going out to get advice instead of just putting blanket rules. But each country's handling it differently, and the whole idea of decentralization was that it wouldn't even be compiled to this. So there's so many people that I speak to that are just like, screw it, I'm not going to pay my tax. Or like, I've not declared tax for 5 years, but the times are changing and the governments are aware of that. And as you know, they say that the only two things in life are death and taxes. So on that, you mentioned about this is just the individual level. How's that even implicating the business level?
Yeah, I think one of the things we can probably all agree on is we want more adoption of blockchain technology and crypto. And it's still somewhat a little bit fringe. And I think if we really want to get to that mainstream adoption and institutional adoption and advancement, I think there's got to be clear regulation from a financial perspective and from a tax perspective, so that we get the big players in the space, and it's really clear to everyone what the rules are, where the taxing points are, and then you'll see a lot more buy-in. So I think that's critically important. I think everybody really wants that. I don't think, by and large, I think everyone accepts that you pay tax on everything else, you're going to pay tax on crypto. Where it gets really interesting and challenging is where you're running a business, not just being a trader or running a node or something like that, but you're running a platform. That space is highly complex, especially when it's cross-border. And I guess many of us probably know UAE is a great destination at the moment for crypto, very encouraging of founders and HQs to set up there. And it's a very, very tax-friendly environment. But as soon as you have a business that spans jurisdictions, you have a challenge as to, well, where do you get taxed and how do you get taxed? Just because you set up in Dubai doesn't mean that your revenue from Australia doesn't get taxed there. Australia could tax it. If you sell into another jurisdiction, you could get taxed there. If you have employees in this new world that we live in, very flexible work, you have employees or developers that sit all over the world, you could then set up taxing points for your organization in all these different countries. So not only are the tax rules in terms of when you get taxed challenging, but even how you structure your business. And the interesting thing with crypto and funds is there's a lot more AI involved. So if you set up in Singapore or in the UAE and you've got a fund there, and that fund is sort of running through AI, well, what does that mean? That's a real challenge, because the tax laws don't really know how to deal with some of those things. So, even if you go and get advice, people, there could be a difference of opinion. How do you get certainty? A very popular strategy in tax is to go to the tax office and get a ruling. But in this space, I would say, well, do you want to be the first person to walk into or company to walk into the tax office on a complex issue and ask for a ruling? And then, the tax office will, in effect, be bound to try and give you something. And that could well go against you, right? And it gets very hard to walk away from that once you walk into it.
Can I just add a little bit further there to reflect on the tax system and how it operates, and it has developed over time, a long period of time before technology has advanced the way it has. So we're looking at a tax system that is based on the residency status of the entity, the taxpayer, and the source rules. So if you're working literally in Australia, for example, you're going to be sourced, it will be Australian source. So the fact that we have a digitally enhanced economy where we're becoming more and more digitalized, more and more things are going online, raises fundamental questions about how Australian tax jurisdiction overlaps with the online, which is decentralized and growing so. So the issues of Australia keeping competitive, allowing innovation, entrepreneurship without sending people and businesses offshore is a real issue that has been flagged, and we've got to be mindful that if we're not competitive in our tax system, people do move offshore, and they will look elsewhere. So with the Board of Tax Review, with how this is being examined, that needs to be part of the story, and it is being brought to the forefront because the purpose of taxation is to raise, for example, government revenues, to build our roads, to do all these things, to support the community, to promote desirable activities and so forth. So if we're going to lose this through offshore, moving offshore and so forth, that's a real concern. It needs to balance how this system operates in a digitalized world that it doesn't have necessarily a connection, and we can get into DAOs here, decentralized autonomous organizations, which open up a further can of worms in respect to how do we even characterise them from a taxing point of view. The issues that we raise if we contemplate if they are considered a partnership, every single participant coming and going, there's a constantly revolving door of partnerships, but also the liabilities to each individual participant. As opposed to if we characterise it as an unincorporated entity. And the flow-on effects for characterising the income coming from these are equally problematic. And we can look offshore to Wyoming to see how they have introduced a new legal entity and the benefits that offer. So, from a business perspective, if we're going to be innovative in this space, we've got to look at holistically the legal system and frameworks around activities and different categories of taxpayers. So whilst there's a lot of focus on individuals and the taxing implications there, looking broader, there's a lot of big issues that have to be tackled.
Yeah, I'd actually love to dive into the DAOs thing. I think that's maybe what Neil was about to comment on. So I'd love to dive into understanding a bit more about the implications for DAOs.
I was just going to pick up on a point that Elizabeth mentioned around innovation. It's really interesting. If you look at the former government, we actually were announced a patent box regime, which is really highly encouraging of innovation, and it hasn't gotten bipartisan support, so it may actually fall away. But the whole purpose of that was, Australia as a country has been really good at R&D. We've come up with a lot of great ideas. We just haven't been able to commercialize them, and all of that goes offshore. To Elizabeth's point, we lose a lot of that. We lose the talent. We lose the innovation. We lose the commercialization, which is critical for businesses, right? So the patent box regime was going to be something that allowed you to make money from that, commercialize that, and get a lower tax rate. Now that's sort of fallen away. So it'll be really interesting with the current government to see where their focus on innovation is going to be, especially with the raft of multinational rules that they've kind of announced, which is sort of almost taking a step back from that. So I think that's quite interesting. And with this debate now, I'd be interested to hear what Danny has to say just from a policy perspective, especially running a business. I think that'd be an interesting one to hear.
Yeah, that'd be great.
Yeah, so I think there's two things that's going on at the moment, and there's a Board of Tax Review that's come out to actually seek to get the right tax outcomes more from a tax technical perspective. But I think what that means is we lose the opportunity to set economic policy to determine how is Australia actually going to see innovation in this space and legislate around it, make crypto a friendly industry to thrive on in the future. And I think that's something that's still being kind of debated and discussed. There's a little bit of taboo around crypto assets and digital assets, often linked to kind of nefarious activities. And I think Chainalysis themselves have done a lot of research in this space to show that there are a lot of in most cases there are a lot of legitimate purposes philanthropic purposes behind crypto, and it's actually very much the exception that are kind of the illicit kind of behaviors that there is still some kind of negative connotation around. But I think what's really important to see is actually the innovative use cases around blockchain technology and what it will see in the future. And so hoping that Australia will see that opportunity going forward and combine that with the Board of Tax Review, because that will really set precedent as to how we approach things. We talk about regulation. I think tax is just one facet of regulation, but in this space, it's really important when you see jurisdictions like the UAE taking a very friendly approach. Investors are generally very fickle in this space. They will move their capital to a point where they have a jurisdiction that they can get certainty on in regulations, that the regulation is friendly to them to actually run a business. And often it's not about paying the lowest amount of tax. It's just about knowing about getting certainty. And I know that businesses basically crave this, right? So I think that's just something that's really important to know as well, and how the policy falls out behind that.
And I would love to dive into the point of the certainty, but one thing I'll kind of add, even on a personal level, is the government seems to be aware of the impact of both innovation. I myself come from a tech background, and there's a new visa type called a global talent visa, which I was awarded to allow to be stay in Australia because I'm not really from here. And before, they just had digital technology on there. And actually last year, they added finance and blockchain technology to the global talent visa pathway. And that actually allows people that have blockchain experience to go from wanting to live in Australia to becoming a permanent resident in like 6 weeks. Where people normally can spend years trying to be a permanent resident, the government opened up a pathway specifically for financial technology and blockchain. And part of the reasons for that is seeing stuff like Afterpay do so well here, and seeing those tech unicorns, identifying them, and then seeing the move into crypto, that they've opened up a pathway now to bring in people from overseas to help facilitate it. So even though like taxation is such a contentious subject, they actually are trying to support the ecosystem.
Yeah, I think it's a good point to sort of think about the blockchain on the one hand and crypto on the other. Crypto certainly gets a bad rap, but if you think about the adoption of blockchain, that's really sort of gone off so many use cases, right? And that's driving legitimacy as well. And I think one of the important things, going back to innovation, and I think we sort of lost the thread a little bit. I diverged from that, but the DAOs, are fantastic for innovation, and they're fantastic for generating, attention and directing funds into spaces that we wouldn't ordinarily see. When you look at big business, Pharma's a great example. Pharma will pour a lot of money into drugs and products that are going to go, blockbuster. But for more niche things, they will not pour money into R&D. But you can easily see the use case of a DAO for orphan drugs or exotic cases, where the community can actually get together and globally and generate funding for R&D in that space through a DAO, regardless of where you are, where you're located. So there are some really positive use cases for that. Now they, as Elizabeth pointed out, they do have some tax implications, because how is a DAO recognized in different jurisdictions? How are the individuals taxed? That's a complex area.
And just to, I guess, add, like, what this really highlights is, whilst there can be problematic activities on blockchain that create that bad rap, that doesn't actually stop the tax implications from actually being real and problematic to participants too. So whilst we need to recognise that there can be problematic activity, and the government at the moment is currently quite concerned about scams, there's a lot of innovation and positivity coming from this space, and that's only going to grow. But there has been a little bit of movement in the government recognising the capabilities of this technology, and that can be seen, for example, in the proposed amendment to the foreign currency regime. Whilst it's designed to specifically exclude Bitcoin from being defined as a foreign currency, what they're proposing is recognizing government-issued crypto assets. So that really highlights that there is a shift beginning to be seen by government, that we're actually seeing that they do acknowledge that there is a space for that moving forward, and potentially we're going to see that grow even further.
Yeah, we just saw a great investment actually into what's called a digital finance cooperative research center, which is, as taxpayers, we get to see where our money goes, whether it goes into Medicare and roads and services, and research centers are actually part of that. Now, based in Sydney, there is a digital finance cooperative research center that the government is using to work alongside RBA for stablecoins. And that only came out like a couple of weeks ago, the announcement that was going to happen. But with such a constant changing state of affairs, Lizzie, like, how do you see that being challenging for tax practitioners? Because Koinly providing software to help you do the tax, we get inbound phone calls on our customer service line on a daily basis from tax practitioners who say, I keep getting these reports that say Koinly at the top. And we have a platform for both like individuals, but also for the accountants, because they're trying to understand themselves, like, what is the implications for us? What are the regulations? So Lizzie, like, how challenging is it for them to keep up to date?
It is, for want of a better word, a little bit of a nightmare, this space at the moment. On one hand, traditionally, the individual income tax return has been slowly being diminished in the role of the tax practitioner, owing to the likes of MyTax being there to really support that basic function of getting individual tax returns done. But now we're seeing this space where it's highly problematic, it's highly time consuming. They don't necessarily have a sound education in blockchain technology. That's quite a rarity. There's certainly many that have a growing presence of those with that expertise, but they're generally experts in tax because they're tax practitioners. And so this is really setting the stage for a really difficult time, because at the moment they're having to comply, they're having to ensure that they provide appropriate services to taxpayers. They need to do so with reasonable care, being competent in what they do and understand their client affairs. But if blockchain is moving so quickly, if the technology is so complex, it comes down to the particular protocols, it is incredibly challenging for tax practitioners to fully grasp what is going on. And in the meantime, the ATO guidance, a lot of it that is binding on the commissioner was written in 2014. So a lot has happened since then. Whilst the web guidance is there, it is updated without a lot of notice, without a lot of answers like when is that staking reward derived. It provides general guidance that the practitioner can't rely on, or the taxpayer can't rely on to the same extent that they can a tax determination. So they're put in a really difficult position from an administrative point of view, and they have to ensure that they do a right job. And it's certainly something that's being brought up with the Board of Tax Review.
And I just want to give an example on that, because we're kind of left in the dark at the moment. We've got this ATO guidance that is, as Lizzie says, non-binding. There's nothing in law yet. There's some draft legislation around the foreign currency rules, but essentially, taxpayers are open to taking alternative positions than what the guidance is out there. The guidance is just the ATO's interpretation of the CGT law. But I'll give an example as to some of the challenges we're facing. Last week, the ATO silently updated their guidance on airdrops, and no one noticed it, and it was an absolute nightmare. And so what happened essentially was airdrops have always been treated as taxable at market value when you receive. So when you receive an airdrop, even if it's completely unsolicited, the best read of the guidance was that you'll get taxed on market value when it's dropped. So often these are scam airdrops. They will be unsolicited. You might not have been asked for that airdrop, but you've been dropped something off a value. And at that point, it's been dropped in your wallet. You're up for tax on revenue account. Now, silently last week, the ATO went and updated that and differentiated between something called initial allocation airdrops And they're saying, well, if it's the first airdrop of its kind and it's not an existing token, there's not an existing market for it, well, there's no taxing point when you receive it. It'll still be a capital gain asset. So let's say you go and sell it a year or two down the line, that's still subject under the capital gains regime. But the point is, it was silent. There was no guidance. There was no, hey, taxpayers, hey, advisors. We're actually updating our guidance there. We think we should look at it. And the other thing that was interesting was the timing, because I think it was 7th of September they updated this guidance. Now, if you think about the tax year starts in July, most people have done their returns. I haven't done my return yet, but most people that have their organization together will have done their returns, or accountants are keen to lodge their returns, or people have bugged their accountants to actually lodge the returns so they can claim any refunds or whatever. But point is, people will have lodged returns in good faith with the old guidance, paid that, included that additional income, and now they're in a position where they have to decide, well, do I have to amend my return and reclaim some of that that income? And I think I worry that in many cases people just won't know. And I think that's a real issue, and I'm certainly going to raise that in my Board of Tax submission, but it's just something that the everyday investor kind of doesn't realize, and we're in this kind of space where it really is difficult to navigate.
And I can just add to that. So that certainly came up in the Board of Tax session I was in the other week, and I raised it there thinking, it's been updated, and pretty much all the people in that room hadn't been aware of that. So it was a brilliant moment for really sending a clear message to the Board of Tax that this is an issue. I mean, it's a double-edged sword though. We need that guidance. We need that clarity. It's a step probably in the right direction, but the effectiveness and the efficiency in administrating the tax system, we have to do better, because we have to be in a position where we're confident that we can get the tax right now. It's post 30 June. So this information needs to be ready before then, and to have a change that is meaningful, whilst welcomed, is highly problematic. And it's a further example to really the pre-filling function in general. There was a little bit of hoo-ha at the end of, I think, July with pre-fill reports that hadn't been fully updated or fully complete, and a lot of manual, I think it was about 12,000 or something, returns had to be manually reviewed and potentially amended because they were submitted before pre-fill reports had been finalised. I mean, it just highlights the wasted resources and the problems. So, if taxpayers are trying to do the right thing, we've got to have a system that enables that to be done efficiently and effectively as we can, recognising that this is a moving beast, that things do change quickly, but it doesn't mean that it has to work. It has to work.
And that leads me to one of my closing questions, actually, which is probably towards Neil, which is how likely do you think we are to see a change in this tax law because of the Board of Taxation review?
I was just going to say, in relation to the airdrops, maybe someone at the tax office knew the merge was coming and was preparing for it. They're expecting some airdrops themselves.
Yeah.
But I think it's a good point. So we are going to see a change in legislation. That's inevitable. I guess the question is really, are we going to see a separate tax regime just for crypto? And is that going to be, something that's released all at once? Or is it something that's going to be more incremental to try and understand some of the complexities? And I just can't see in the space of time that we have, and the complexity and the fast pace of how crypto is moving, that we would get something that says, here's your crypto tax regime, off you go. I think it's going to be incremental, it's going to evolve over time, and it has to, right? Just because of the pace of movement. But I think it's still very much, at the moment, it's still very much on the individual to kind of try and make a call as to, are you a trader? Are you running a business because you're running a node, or you're running a mining rig? Where do you stand? And especially with the way the market's gone, I mean, people probably have suffered some real losses in sort of Jan, Feb this year. If you treat that as capital, like the tax office probably wants you to, well, that's quarantined against all your other income. So it's a real double whammy for you. So you have to think really hard as to what position you're going to take. But there's still flexibility to take a view and take a position on that. And I think that's what you need to think about at the moment. But once the tax office comes out with some of these, not the tax office, once the board of tax comes out with some of these rules, they could get quite prescriptive and lock you into a treatment.
And so something I was going to say is, like, it's a pleasure for us as a company like Koinly, who actually just provide the software for accountants and traders to be able to at least understand this ever-moving landscape, to have someone like Danny, who literally, Danny's sole job is to understand the tax regulations and represent us, and even represent you as our users, because with the information that comes in, we can go into these conversations and at least be part of them and be able to help understand that changing framework. I think Danny wants to add a point.
I just wanted to go back on one of the examples, just on the back of what Neil was saying. So at the moment, staking income is taxed on income basis. So it's outside of the capital gains regime. And so what's happened a lot is values have dropped in the recent market cycles. People have been liable for income tax on revenue account as they're accruing these staking rewards, but underlying asset has actually dropped in value. And so the investors realizing a loss, or they may not have realized it yet, they might still be holding on to a loss. But when they plug into their Koinly accounts or work through with their tax accountant, what they actually are liable for, they kind of see all this tax accruing from a staking income perspective, but they can't offset any of their losses against that income because it's ring fenced against that capital gains regime. And so that's also kind of a misconception as to, does it make economic sense that you're deriving something from the asset by staking and not able to kind of recoup any losses on the income that it's generating? And so that's something that does cause a lot of confusion. I think, you can think of it a little bit like a stocks and shares when you're getting dividends, and the treatment is similar. But on the other end of the spectrum, you have, these new projects. Like, I think a key question we always get is how we deal with all these nuanced projects like SafeMoon and reflection tokens, and those values update every 2 seconds and they're not recorded on a blockchain. So we have like text coming into our customer service like, hey, how do we deal with SafeMoon? And by the way, when I sell it, 5% of it goes to the existing SafeMoon holders. So my price changes every 2 minutes, but I can't actually check it because it's not recorded on chain. And when I look at the Board of Tax Review and what's been done, I really don't think there's an existing regime that can actually encompass those types of complexities, because the way we use these assets and what they are just not what we've seen before. They're not stocks and shares, they're not equities, they're not investment properties. They are something quite different, and I think until we understand that, it's going to be a real challenge from a tax perspective.
And that leads me kind of into our closing question, which is, with it being such an ever-changing environment, and we understand the government's trying to understand it as we're moving, you only need to walk around this amazing convention to see the different types of projects. I'll open it up to the panel to say, how do you see the adoption of digital assets changing in the future for everyday users like us here as a closing point?
I'll go first since I have the mic. So I think from my perspective, what I've seen is this maturity in the industry going through. And so, in the early days, there was very much kind of like a cowboyish nature to the crypto industry. A lot of people thinking they can make a quick buck just by going in and not really understanding what they're buying and what the underlying asset is. I think NFTs were a great example of that to a certain extent. But I think what you're getting now is a lot of people coming to this space really questioning, well, what is an NFT? And I think these are debates that, people, certainly from a Board of Tax position, we're trying to understand, people are saying, well, an NFT is a collectible. Well, it's really just a bit of code on a blockchain, and then you've got different types of ERC20 tokens and so on. And so it's a case of fundamentally what people use NFTs for might be very different to another person's use. Some people might see it as artwork, some people might see it as investment. And so I think what we'll see as the industry moves forward is this maturity, and particularly with the token mapping exercise being done by Treasury, we're going to see a bit of a category definition of what these crypto assets are, which will then feed off into all sorts of policy decisions. And I think that will be important to then give certainly some legitimacy, but also kind of some status and a platform for businesses to innovate on with some level of certainty.
I think everybody wants to be able to use their crypto. At the end of the day, you want to be able to spend it as much as you want to be able to make it. So I think as the the industry and the economy matures, you'll have more businesses accepting crypto and transacting in crypto. I think that's the next phase of evolution. And like you said, the tech industry matured, and we see tech now as not necessarily an end in itself, because all businesses are to some extent tech enabled. So I think businesses will ultimately be crypto enabled or blockchain enabled, even better, and that'll have some real benefits. So if you're buying or selling a house, you'll have instant settlements through the blockchain. It'll become more pervasive, and it's not just about, as you said, can I make a quick buck on crypto? We want to be able to legitimately use and spend crypto on all manner of things, and I think that's where we're headed.
From my perspective, it is that connectedness with the real world. So I think the developments are going to continue. We're going to see amazing evolutions in the technology, but it's about how it actually connects to the real world off chain, and that's where the regulatory frameworks lie. So understanding how the regulatory frameworks emerge in line with the digital technology, the digital versions will be incredibly important and also legitimizing. So the ability to provide advice when needed, because we understand how it fits in with a particular regime. We can understand how the tax, the interpretation of tax principles apply. I think that's where we're going to have to move. I think it will be very iterative. I don't think the Board of Tax review will necessarily be terribly immediate in an outcome, but we might get some initial low-hanging fruit type amendments to at least help us along the way. But I think it's that movement towards working with frameworks, working with jurisdictions as it progresses and evolves that we'll see as an important step.
One thing I would add as well is what's increasingly important is also to make sure that we read all the terms and conditions attaching to the things that we invest in. I know you mentioned NFTs, and there's virtual land and stuff like that. I mean, when you're investing in niche platforms, it's really important to understand, well, what are your rights and obligations when you're investing? Is a piece of virtual land, or is it a bunch of code? And is it going to remain land, or is the platform tomorrow going to change it into a magic wand or a broomstick or something like that? So what exactly do you own, and what are you going to be taxed on? I think that side of things is super important as well.
Awesome. Guys, firstly, I just want to say thank you to the panelists for joining us today and to have this conversation. From my first journey of when I worked at a startup and I was mining Bitcoin secretly on the laptop back in 2012, from when I was doing that to selling it when it hit, I think, $18, and regretting it many years later, to sitting here today, has been an absolute pleasure to share it with the crypto community. And to see so many people here today is an absolute pleasure. I really appreciate all of you being part of the community. And I'd love it if you can put your hands together for the panelists of sharing this today. If you do have any questions, you can see myself, Danny, and a few of the team at the Koinly booth. We've got a bunch of swag to give away. And also we have $1,000 of Bitcoin that we're going to give away. So feel free to come and scan the QR code, enter the competition. We had a competition winner here today that we brought up and gave 2 nights in the Star and Crypto to from winning a competition here. So, at Koinly, we love to give Bitcoin away. So we'll see you at the booth, and thank you for joining.